Robert Castillo spent 41 years teaching 7th grade history in Clark County, Nevada. He graded papers on weekends. He coached junior varsity basketball until his knees said no. And in June of 2024, at 63, Robert retired. His wife Carol threw him a party. His kids flew in from Phoenix and Portland. They put a banner over the garage that said "Free at Last," because Robert and Carol had done everything right. They saved methodically for 4 decades through teacher pension contributions, a 403(b) plan, and a brokerage account Carol managed herself. When Robert rolled over his pension and consolidated their savings, the total came to $2,140,000. Robert looked at that number on the screen at his local bank branch and felt something he had never felt before: safety. Total, permanent safety. He told Carol, "We made it. Nobody can touch this." That single sentence, spoken in a bank lobby in Henderson, Nevada, was the most financially dangerous thing Robert Castillo had ever said, because every word of it was wrong. Listen, I need you to sit with that for a second. A retired teacher with $2 million in the bank, in your mind, that man is safe. He crossed the finish line. But here is what Robert did not know, what his bank did not tell him, what his financial advisor never once mentioned. For the moment Robert deposited $2,140,000 into a single individual checking account, he did not become a wealthy retiree. He became an unsecured creditor, a lender. He was lending his life savings to a for-profit corporation, and the federal government was only guaranteeing the first $250,000 of that loan. The remaining $1,890,000 had zero federal protection, none, not a dime. It was sitting in a digital vault with no lock, no alarm, and no insurance policy. Robert did not know that. His bank was not going to tell him. And the mainstream financial media were never going to interrupt their travel point segments to explain that a retired teacher's life savings were legally exposed to confiscation in a bank failure. This is the bail-in confiscation trap. And if you have more than $250,000 sitting in a single bank account right now, you are standing exactly where Robert Castillo was standing. You are not a millionaire. You are an unsecured creditor volunteering to recapitalize a failing bank with your retirement savings. And the system that created this exposure has zero incentive to warn you because your uninsured cash is the cheapest possible funding source for every bank in America. So let me ask you this before we go any further. If you have worked your entire life, if you have sacrificed vacations and new cars and additions to your home so that you could save responsibly for retirement, do you not deserve to know the exact legal mechanism by which that money can be taken from you overnight? Do you not deserve to understand the 3 words buried in federal banking law that reclassify your savings as someone else's asset the moment you hand it to a teller? If you believe the answer is yes, then smash that like button right now. Not for me, not for this channel, for the algorithm. Because in 2026, the platforms are actively suppressing financial education content that contradicts the banking industry's preferred narrative. Every like you give this video is a signal to the algorithm that retirees deserve the truth. Subscribe to this channel and flip that notification bell because the archive does not run on advertising revenue from the same banks we are exposing. We run on you showing up. Now, let me show you the math they never wanted you to see. The Federal Deposit Insurance Corporation was created in 1933 after the Great Depression to guarantee the safety of bank deposits. And for decades, the FDIC has done exactly that. No depositor has ever lost a single penny of FDIC-insured funds. That is a fact. What I'm about to tell you is not that the FDIC does not work. What I'm about to tell you is that the FDIC has a ceiling, and that ceiling has not kept pace with the wealth accumulation of retiring baby boomers. The current FDIC insurance limit is $250,000 per depositor per insured bank per ownership category. That number was last raised in 2008. It has not moved in 18 years. In 2008, the median home price was roughly $200,000. Today in 2026, that same home might sell for $450,000. Inflation has marched forward. Asset values have climbed. Retirement balances have ballooned, but the FDIC limit has not budged. It is frozen at $250,000. Here is the paradox. The person with $100,000 in the bank is 100% protected. Every dollar insured by the federal government. Now look at the person with $500,000 at the same bank. $250,000 protected, $250,000 exposed, 50% 50% insured. The person with $1,250,000 protected, $750,000 exposed, 75% uninsured. The person who did what Robert did, depositing $2,250,000 insured, $1,750,000 unprotected, 87.5% exposed. The more you saved, the more responsible you were, the greater your percentage of uninsured exposure. The system does not reward your discipline, it punishes it. The FDIC insurance structure creates an inverse relationship between wealth accumulation and deposit safety. The richer you are, the less protected you are, and nobody at your bank has any obligation to explain this to you. Now here is where it gets worse. 3 words that most Americans have never heard applied to their own savings: unsecured creditor. When you deposit money into a bank, you are not placing your money into a vault. You are not handing it to a custodian who holds it in trust. Legally, you are making an unsecured loan to a for-profit corporation. The bank takes your deposit, records it as a liability on its balance sheet, and uses your money to fund its own lending operations, its commercial real estate portfolio, its investments. Your money is gone the moment you deposit it. What you receive in return is a promise, an IOU, a claim against the bank's assets, and that claim is classified as unsecured debt backed by nothing except the bank's general ability to pay you back when you ask. This is not a conspiracy theory. This is black-letter banking law. The FDIC's own joint publication with the Bank of England, issued in 2012, explicitly describes depositors as unsecured creditors whose claims can be written down and converted partly into equity to provide sufficient capital to return a failing institution to operation. Your deposit can be converted into equity shares of a failing bank. They take your cash and give you stock in a bank that just collapsed. The suits want me to tell you this is not financial advice. Fine. It is not financial advice. It is a survival guide for an unguarded vault. Consult a professional if you still trust the people who earn fees on the very deposits they are legally permitted to cannibalize. Let me walk you through what actually happens when a bank fails. Because this is not theoretical. 2 banks have already failed in 2026. Metropolitan Capital Bank and Trust in Chicago was shut down by Illinois regulators in January. Community Bank and Trust of West Georgia was closed by the FDIC in May. These are not ancient history. These are events that happened this year in the present tense while you were watching this video, or one very much like it. When a bank fails, the FDIC steps in as receiver. For a standard community or regional bank, the FDIC attempts to find a healthy acquiring bank to assume the failed bank's deposits and assets. If a buyer is found, the transition is usually seamless. Depositors wake up with a new bank name on their account but their money intact, including uninsured amounts if the acquiring bank agreed to take them on. That is the best case scenario. But when no buyer is found, or when the acquiring bank only assumes insured deposits, the process changes dramatically. The FDIC pays out the insured portion up to $250,000, and the uninsured remainder enters receivership. At Community Bank and Trust in West Georgia, $27 million in deposits exceeded the FDIC insurance limit. $27 million from real people, real businesses, real retirees sitting in legal limbo. The FDIC announced it would provide advance dividends to those uninsured depositors, meaning they might get some of their money back over time as the failed bank's assets are liquidated. Might some. Over time. Those are not words that should appear in the same sentence as your retirement savings, and that is what happens with a small community bank. For the large banks, the systemically important financial institutions, the SIFIs, the mechanism is even more alarming. Under Title II of the Dodd-Frank Act, the Orderly Liquidation Authority gives the FDIC the power to resolve a failing megabank by creating a bridge institution, wiping out shareholders, and converting the claims of unsecured creditors, that is you the depositor, into equity in the new entity. This is the bail-in, not a bailout, where the government uses taxpayer money to rescue the bank. A bail-in, where the bank uses your money to rescue itself. Your $2 million deposit becomes shares in a restructured institution that may or may not ever be worth anything. This is not speculation. This is the explicit legal framework published jointly by the FDIC and the Bank of England. This is the architecture. Save this video right now. Save it to your private library. Bookmark it. Screenshot the next section, because what I am about to give you is the exact playbook the wealthy use to make sure they are never, ever caught standing where Robert Castillo was standing. Let me show you what the math looks like state by state, because this is not a one-size-fits-all problem. The exposure varies based on where you live, how your accounts are titled, and which state laws interact with federal FDIC rules. In Florida, where No state income tax on retirement distributions. Retirees tend to accumulate large liquid balances. A retired couple in Naples with $3 million in combined savings at a single bank has $500,000 of individual coverage, $250,000 per person, and $2,500,000 exposed. Florida's strong homestead exemption protects their primary residents from most creditors, but it does absolutely nothing to protect their bank deposits. The homestead exemption is a real property shield. It does not apply to cash. So the couple with a paid-off $3 million waterfront home and $3 million in the bank has ironclad protection on the house and nearly zero protection on the cash. The irony would be funny if it were not devastating. In Ohio, the calculus shifts again. Ohio retirees tend to have lower account balances on average, but the state's cost of living means that a $750,000 balance represents a lifetime of disciplined saving. At that level, the retiree has $250,000 insured and $500,000 exposed. Ohio does not have the same homestead protections as Florida. The homestead exemption in Ohio is capped at approximately $25,000. So the Ohio retiree with $750,000 in the bank and a paid-off home worth $200,000 is exposed on the cash and minimally protected on the house. In a worst-case banking crisis, they lose the cash above the FDIC limit and the house is vulnerable to other creditor actions. In California, everything is amplified. California retirees face state income tax on retirement distributions, higher property tax reassessment risks under Proposition 19, and a cost of living that turns a $2 million balance into what feels like a moderate cushion. The California retiree with $2 million in a single account has the same $250,000 FDIC limit as everyone else, but the purchasing power of that insured amount in Los Angeles or San Francisco is dramatically lower than it would be in Toledo or Tampa. And as of the 1st of January 2026, California reinstated asset limits for Medi-Cal eligibility after a 2-year suspension, meaning that large unprotected bank balances could also jeopardize long-term care planning. The exposure is not just about bank failure. It is about the downstream cascade of having concentrated, visible, unprotected wealth sitting in a single institution. Tell me in the comments right now, do you currently have more than $250,000 sitting in a single bank account? Do not tell me the number. Just tell me yes or no. And tell me this, did your bank ever, even once, sit you down and explain the FDIC limit and what it means for your specific balance? I want to hear those field reports because I already know the answer. They did not tell you. They never tell anyone. Because your uninsured deposit is the cheapest money a bank can borrow. Now let me show you the shield. Let me show you the strategy that the elite use, the family offices, the ultra-high net worth individuals, the people whose accountants actually earn their fees. There are two primary mechanisms that can take your FDIC exposure from catastrophic to zero, and neither one requires you to open accounts at 20 different banks or stuff cash under your mattress. The first mechanism is trust titling, sometimes called beneficiary stacking. Under FDIC rules that were simplified in April of 2024, a revocable trust account is insured for $250,000 per owner per beneficiary, up to a maximum of 5 beneficiaries. This means that a single revocable living trust with properly named beneficiaries can multiply your FDIC coverage at a single bank from $250,000 to $1,250,000 without opening a single additional account. Let me walk through the math with Robert Castillo. Robert has $2,140,000. If he leaves it in an individual checking account, his coverage is $250,000. His exposure is $1,890,000. Now, Robert sets up a revocable living trust. He names 5 beneficiaries: his wife, Carol, his son, Michael, his daughter, Jennifer, his daughter-in-law, Patricia, and a grandchild, Tyler. Under the FDIC trust account rules, Robert's coverage is now $250,000 multiplied by 5 beneficiaries, which equals $1,250,000. His exposure just dropped from $1,890,000 to $890,000. He closed that gap by $1 million without moving a penny to another bank. He just changed the title on the account. But Robert still has $890,000 exposed. And this is where the second mechanism comes in, the one that the ultra-wealthy have been using for years and that most retail bankers will never voluntarily mention to you. The IntraFi network, formerly known as ICS, the Insured Cash Sweep. This is a back-end banking system operated by IntraFi, a company based in Arlington, Virginia that connects over 3,000 FDIC-insured banks and credit unions across the United States. Here is how it works. Robert walks into his local bank, a bank that participates in the IntraFi network, and deposits his remaining $890,000 into an ICS-enabled account. He signs a deposit placement agreement. And then the system does something elegant. It takes Robert's $890,000, slices it into increments that do not exceed $249,000 each, and distributes those increments across multiple FDIC-insured banks in the network. Each chunk sits in a separate institution, each one fully insured up to the FDIC limit. Robert's $890,000 is now spread across 4 partner banks, each holding less than the insurance cap, and every single dollar is fully covered by federal deposit insurance. Robert does not have to open accounts at 4 banks. He does not have to manage 4 sets of statements. He does not have to remember 4 sets of online banking credentials. He interacts with one bank, his local branch, the same one he has been going to for years. He sees one consolidated statement. He makes deposits and withdrawals from one account. The distribution happens invisibly in the background, managed entirely by the IntraFi platform, and the coverage is real. It is not a gimmick. It is not a loophole. It is a system used by businesses, municipalities, school districts, and government entities to protect deposits that far exceed the standard FDIC limit. Axos Bank alone offers ICS coverage up to $150 million. Some institutions in the network can provide coverage on checking accounts up to $135 million. This is not a tool built for small depositors. It was built for exactly the situation Robert Castillo is in, and the only reason he did not know about it is that nobody had a financial incentive to tell him. Let me run the complete scenario comparison so you can see the difference between doing nothing and doing this correctly. Scenario A, Robert deposits $2,140,000 into a standard individual checking account at his bank. On a Friday afternoon, federal regulators shut down the bank due to unsafe and unsound conditions and an impaired capital position, exactly the language used when Metropolitan Capital Bank was closed in January. The FDIC is appointed receiver. Robert receives a check for $250,000. His remaining $1,890,000 is frozen. If an acquiring bank takes over, he might get it back. If no acquirer is found, that money enters receivership. Robert files a proof of claim. He waits months, possibly years. He receives partial advanced dividends. He may never recover the full balance. 41 years of teaching, of coaching, of grading papers on weekends evaporated in a single Friday afternoon closure. Scenario B, Robert establishes a revocable living trust, names 5 beneficiaries, and retitles $1,250,000 of his deposits under the trust at his primary bank. He places the remaining $890,000 into an ICS sweep account at the same bank. The bank fails on the same Friday. The FDIC steps in on Monday. Robert loses $0, not a penny. His trust deposits are insured at $250,000 per beneficiary, totaling $1,250,000. His ICS deposits are distributed across partner banks, each fully insured. The bank failure is an inconvenience. Robert might have to switch to a new branch, but his $2,140,000 is intact, every cent. The difference between scenario A and scenario B is not luck. It is not wealth. It is not connections. It is information. Information that Robert's bank had every opportunity to provide and chose not to. Send this video to one retiree you care about, not tomorrow, today. Send it to the friend who just sold their house and has hundreds of thousands of dollars sitting in a basic savings account. Send it to the sibling who rolled over their 401k and parked it in cash at a single institution while they figure out what to do. One conversation now saves them $75,500, $1 million later. Do not let the people you love be Robert Castillo from scenario A when scenario B costs nothing and takes one afternoon to set up. Now let me give you the action checklist. This is the part you print out. Or better yet, save this video and come back to this section when you are sitting at your bank. Step 1, pull up your current bank statements, every account, every institution. Calculate your total deposits at each bank, not your net worth, not your investment accounts, just your cash deposits. Checking, savings, money market, CDs. If the total at any single bank exceeds $250,000 in any single ownership category, you have uninsured exposure. Write that number down. That is your vulnerability. Step 2, determine your ownership categories. An individual account is one category. A joint account is a separate category, insured up to $250,000 per co-owner. A revocable trust account is a separate category, insured up to $250,000 per beneficiary, maximum 5. Retirement accounts, IRAs, and certain self-directed plans held at the bank are yet another separate category. Each category gets its own $250,000 limit at each bank. Most retirees are only using 1 or 2 categories when they could be using 3 or 4. Step 3, if you have a revocable living trust, which you should for probate avoidance and incapacity planning, retitle your primary deposit account under the trust. Make sure your trust document names at least 5 primary beneficiaries, not contingent beneficiaries, primary. Each primary beneficiary multiplies your FDIC coverage by $250,000 at that bank. If your trust currently names only your spouse, consider adding children or grandchildren as beneficiaries to maximize coverage. This does not change the distribution provisions of the trust. It simply changes who the FDIC counts when calculating insurance limits. Step 4. Ask your bank manager this question. Are you a member of the IntraFi network, and do you offer insured cash sweep accounts? That is the question. Write it down. Memorize it. If the answer is yes, ask them to walk you through the deposit placement agreement and explain how excess deposits above $250,000 are automatically swept to partner banks for full FDIC coverage. If the answer is no, find a bank that does. Over 3,000 institutions participate in the IntraFi network. You can search participating banks directly on the IntraFi website. There is no reason to keep your money at an institution that cannot provide this basic protection. Step 5. For amounts exceeding what trust titling and ICS can cover, consider the CDARS option, the Certificate of Deposit Account Registry Service, also through IntraFi. This works the same way as ICS, but for certificates of deposit. Your bank places your CD funds across network banks in increments below the FDIC limit, and you receive one consolidated statement. The trade-off is reduced liquidity, since your funds are locked in CDs, but the coverage is identical. For retirees who do not need immediate access to a portion of their savings, CDARS provides another layer of fully insured protection. Step 6. Run the numbers one more time after restructuring. Add up your insured coverage across all categories and all institutions. Compare it to your total deposits. The goal is zero uninsured exposure, not low exposure, not manageable exposure, zero. Every dollar above the insured amount is a dollar you are lending to a bank with no collateral, no guarantee, and no recourse beyond a proof of claim in receivership. That is not a financial strategy. That is a gamble, and you did not work for 40 years to gamble with the result. Step 7. Document everything. Keep a written record of which accounts are titled under which ownership category, which beneficiaries are named on each trust account, which bank participates in which sweep network, and what your total insured coverage is at each institution. Update this document annually or whenever you make a significant deposit or withdrawal. This is your financial insurance audit, and it is every bit as important as reviewing your Medicare enrollment or your tax withholding. Let me address something I know some of you are thinking. You are thinking, this sounds like a problem for multimillionaires. I do not have $2 million, and I hear you. But listen carefully. In 2026, after decades of home price appreciation, after years of diligent saving, after pension rollovers and 401k consolidations, and the sale of a business or a rental property, the number of retirees with cash balances exceeding $250,000 is higher than it has ever been. You do not need to be wealthy to be at risk. You need to have saved consistently. And if you sold a home this year, if you received an inheritance, if you rolled over a retirement account and parked it in a money market fund at your bank while you figured out your next move, you might be sitting on an uninsured balance right now without even realizing it. The One Big Beautiful Bill Act, signed into law on the 4th of July 2025, made the TCJA tax brackets permanent and introduced a temporary senior bonus standard deduction through 2028. The estate tax exemption was raised to approximately $15 million per individual. These are real protections for retirees, but not one provision of the OBB did address the FDIC insurance limit. The government found the political will to make tax cuts permanent, but could not raise the deposit insurance limit above the number set in 2008. The suits will tell you the banking system is sound, that failures are isolated, and I will point you to the 2 banks that failed this year and the $27 million in uninsured deposits flagged at just one of them. Here is the final thing I need you to understand. Bank runs do not happen the way they happened in 1933. They do not require lines around the block. They happen on social media, on group chats. When a rumor about a bank's commercial real estate exposure goes viral on a Thursday evening and depositors start moving funds electronically before the branch opens on Friday. Silicon Valley Bank in March of 2023 saw $42 billion in withdrawal requests in a single day. That was not a Depression-era bank run. That was a modern digital bank run, coordinated through technology that did not exist when the FDIC limit was last set. The FDIC ultimately covered all depositors, insured and uninsured, using the systemic risk exception. But that exception was a political decision. It may not be made again. The lesson is not that the FDIC will always bail you out. The lesson is that you should never need them to make that decision about your money. You should be structured so that every dollar is within the insured limit. You should be invisible to the crisis. You should be the person who reads about a bank failure in the morning paper and says, that is terrible, but it does not affect me, because you took the 3 hours it takes to retitle your accounts and sign up for a sweep network. Robert Castillo's assumption that his bank was too big to fail exposed $1,750,000 of his life savings to immediate confiscation. Decades of hard work, decades of sacrifice, decades of doing the right thing, all sitting in a single uninsured account because no one told him there was another way. Do not be Robert, not today, not this week. Review your bank account titling, calculate your exact uninsured exposure above the $250,000 limit, and ask your branch manager about IntraFi sweep networks immediately. Do it before the next failure. Do it before the next social media rumor. Do it before the next Friday afternoon closure. The window for preparation is always open until the moment it is not. And once your cash is finally secured across multiple accounts, across multiple ownership categories, with full FDIC insurance on every dollar, you need to understand what happens next. Because the IRS has reporting triggers that activate when you start moving large sums between institutions, currency transaction reports, suspicious activity reports, the $10,000 structuring rules that can turn an innocent deposit strategy into a federal investigation if you do it wrong. That is the next video. And if you think the FDIC trap was bad, wait until you see what the IRS does when you try to fix it without understanding the reporting architecture. Subscribe to the archive, hit that bell, come back for the next one. And for the detailed breakdown of every strategy I mentioned today, the trust titling math, the ICS sweep walkthrough, the state-by-state exposure calculations, go to retireshieldreport.com. The full report is waiting for you. retireshieldreport.com. Print it, share it, use it, because nobody else is going to hand you this information while they are busy earning interest on the money you do not realize is already at risk. Tell me in the comments which document you are filing first, the trust retitling at your bank or the ICS deposit placement agreement. I want to know. This channel runs on your field reports. And every comment you leave, every story you share helps the next retiree who stumbles onto this video at 2 o'clock in the morning wondering why their bank never mentioned any of this. Be that signal for someone else. You found the archive. Now help someone else find it.